PepsiCo Inc., ticker symbol PEP, is currently trading at $144.71 a share. It is down 13% over the last year, and if we take the chart further out, this is actually the lowest price Pepsi has been since the middle of 2021. So this is a stock with a diversified revenue stream, many beverages and snacks that total up its revenue. But one of the reasons this is a popular stock with investors is because it is a dividend aristocrat with over 50 years of consecutive dividend increases. What we're going to be doing today is looking at the latest company financials using my automated stock evaluation spreadsheet, and then seeing if it is a buy or a sell using the discounted free cash flow model, comparable company model, dividend discount model, and Ben Graham formula for intrinsic value. So if we put in the ticker PEP, this will load up all the latest company financials. If you're interested, check my Patreon, but we'll talk about that more later. PepsiCo Inc., market cap of just shy of $200 billion, a PE ratio of 21.3, meaning it is lower than the market average, which is about 29. Earnings per share, $6.79. A beta of 0.54, meaning it is a lot less volatile than the market. And analysts say it is a buy with $177.50 a share. Now the dividend, 3.8%, meaning you'll get paid $5.49 per share. If you want to get paid your quarterly dividend, buy before the 6th of March and you will get paid. So this is a dividend that the total dividend that Pepsi pays out is $7.5 billion. In terms of the net income, that is 80%. And interestingly, in terms of the free cash flow payout ratio, currently 223%. So it does not look safe, yes, but this is a dividend aristocrat. They always increase their dividends. So looking at revenues, all-time high, $91.92 billion. Beating the prior year, which is the all-time high, and you can basically see Pepsi's revenue has gone up and up and up. They had a slide down from 14-15, but since the pandemic, they've gone from strength to strength and increasing, which is excellent. Now, are they able to generate profit out of this? Yes, they are. Apart from this big blip in 2018, which was $12.5 billion, its all-time highs, they are now at $9.36 billion, which is steadily increasing once again. Free cash flow ratio, interestingly down $3.37 billion, down from the prior highs of around $8 billion. So if we look at the operating cash flow versus capex, yes, you can see here operating cash flow is trending in the right direction, not all-time highs, but the capex of the company is up, meaning the free cash flow is down. Shares outstanding, are they rewarding shareholders? Yes, you can see Pepsi has had a consistent buyback program and rewarding shareholders through share buybacks, because if there's 10 shares of a company and you own one, then you own 10% of the company, 10% of the profits. If the company buys back 5 shares, you would then own 20%. Obviously, it doesn't work quite exactly those percentages, but you can see here they're buying back their shares. So let's have a look at the discounted free cash flow model. This is a way of valuing stocks, looking at their future free cash flows and discounting them to today's value. So initially, it's giving us a price of $110 a share. Let's see if we agree with the numbers, because we're looking at averages. We're expecting 96 and 101 billion in the coming years. Let's see what analysts are expecting. 92, 94. Bullish side, maybe 98. So, well, we'll bring this down just a smidge. $102 a share. Net income margins, I'm pretty happy with that. You can see they've historically been about 10% the entire time, so we won't change that. Here we go. Net income to free cash flow. Currently 68% because of the last year. So if we take an average of the prior years, which brings us to about 76%, that puts us at 113. Now, we use an 8.5% discount rate. Pepsi's currently weighted average cost of capital is 5.68. So you can see that puts it quite at 200, but I do think that is a bit on the high side. So discount rate of 7%, it looks like it's about fairly valued. 6%, I would say, is close to the WACC. Weighted average cost of capital puts it at 180. So a buy, and in line, interestingly, with what the target price is from analysts. Quickly look at the dividend discount model. So currently, this has it as an intrinsic value of $200 a share. We'll bring the, let me just go back to the, here, we've got 6% there. We've got 6% here, fine. So at 3% growth, it puts a $200 share stock. So That looks good in terms of the dividend discount model. Ben Graham formula for intrinsic value. We'll go through this quickly because Ben Graham does not like stocks at the minute because of the high bond yield, and I expected pretty low growth, but this was created by the Godfather investing himself, Ben Graham. And yeah, 5.34% growth. Doesn't like it, $80 a share. But if we got back to, well, we'll go 2.5, I know we're a long way from that, it would be a buy. But unfortunately, AAA bond yield is currently at 5.2, so it does not like it. So finally, we'll look at the comparable company model. This is a way of valuing companies looking at similar or comparable companies, similar businesses of similar sizes in the same industry. So what we'll do is, I think the main one is KO, which is Coca-Cola. That is Pepsi's main competitor in the global beverage market. Another one I will look at is Keurig Dr. Pepper, which is KDP. And then finally, Mondelez. I don't know quite how to pronounce that. We don't have of them in England, but anyway, we will do them as a company, Mondelez International. And what this will do is upload all the company's financial data for all three of these companies. And if you're interested in this sheet, it is the $4 tier in the Patreon. $4 a month gets you full access to this sheet, which gives you access to all the data, and you can do as many stock reviews until your heart's content. If you want to pay the $7 tier, that includes me doing reviews for you. I can on sort of an ad hoc basis, or if you want to help me out, $1.50. Anyway, enough about that. So, enterprise value here, Coke is the largest, Coca-Cola. Revenue, interestingly, Pepsi highest, 91 billion, blows all these companies out of the water quite interestingly. And despite this high revenue, it's still got a pretty good growth rate. Dr. Pepper is the highest growing, but obviously it is the smallest, so that there's more chance for growth. EBITDA highest, net income just shy of Coke. That is 22% profit margin, so Pepsi actually has the lowest. Price to sales, market average is around about 3. And Pepsi is well below that, and also towards the bottom of its competitors. Price to book, pretty high. Market average is 5. You can see it's pretty close to Coca-Cola. Now, PEG, which is Peter Lynch's price to earnings growth. Ideally, you want this under 1, but looking at the competitors again, 2.6, 2.1, and 4.4. Pepsi is lower than all of them. So then EV to revenue, EV to EBITDA, PE, and forward PE. EV to revenue, it is the lowest. EV to EBITDA, second lowest. Coke is the highest. PE, middle of the pack. Forward PE, middle of the pack again. But overall, looking at these averages puts it $173 a share, so that is a buy. If we were to compare just to KO Coke, it would be $200 a share. So Pepsi is looking like a buy compared to Coca-Cola. The dividend discount model likes it. Ben Graham hates it, as he always does at the minute. Comparable company model likes it, and the discounted free cash flow model likes it as well. And obviously, if you're interested in that very nice 3.75% dividend, then you should purchase this stock. As I said, ex-dividend date is the 6th of March, so buy before then if you want to get paid your quarterly dividend. Right, guys, thanks for watching. Please give a like on the video if you enjoy it. Subscribe if you're not already. Check out my Patreon, and I'll catch you guys next time.